All right, for those of you who survived chapter 12, and I hope a good number of you did, let's move on to chapter 13. All right, company analysis and stock selection. So we worked our way through the top-down investment philosophy, if you will, the investment process of starting with the global economy, then looking at the U.S. economy, then looking at industries, and then doing fundamental company analysis, fundamental valuation analysis. And so we're going to take a different look at company analysis in this chapter. So the last questions we look at are, which are the best companies within industries that are expected to prosper? So we look for industries that are going to do well, then we're going to look at companies in those industries. Okay, so what industries will prosper in our anticipated economic environment? And are their stocks underpriced to the extent that their expected returns will meet or exceed their required rates of return? And we talked a little bit about this at the end of chapter 12. Okay, so the best stock ideas have two components. One is a great business story, a business story that you understand, and a business story that has interest and potential, okay? And then secondly, a stock price that has multiples that do not adequately reflect future business success. In other words, the story is good and the stock is undervalued. Now those are the two things that you need to make a good investment, okay? Remember this, the common stocks of good companies are not necessarily good investments. Just because you like a company or its products and services does not make the stock a good investment. The stock of a wonderful firm may be priced so high in terms of its multiples that its fair value falls below its current market price. In other words, the market price is already too high, okay? This would make it a poor investment, at least over the near and intermediate terms. In contrast, the stock of a company with less success may have a fair value far above its current price. So maybe you don't like the company as well, but there's a lot more upside to the stock price and the multiples than the stock of the company that you like better. We're not buying the companies, we're buying the stocks. Okay? This should make it a good investment, at least over the near and intermediate terms. Okay? So keep in mind that we're looking for stocks that will generate an attractive rate of return for us. We'd love to have a good business story, but we'd rather have an undervalued stock. All right. History shows that great business success does not guarantee that an investment will generate an adequate rate of return. The multiples you pay for an asset matter. How much you pay for an asset in terms of multiples, very important to determining what kind of return you're going to get. If you pay too much, business success is not enough. Business success will not overcome paying too much. History also shows that buying a stock that has low multiples does not always guarantee an adequate return. You cannot just look for low multiples. As I said in the first slide, you need a good business story and an undervalued stock in terms of multiples. You could have bought a horse and buggy company on the cheap shortly after automobiles were invented. That's an extreme case, but it makes the point that multiples are low for a reason. Okay? And you better understand, if it's a short-term reason, then you got a good buying opportunity. If it's a long-term reason, then it's what we call a value trap. So you need both components, a good story and low multiples. But if you have to choose, business success is more important over the long run. Yes, buying the stock of a great company is important over the long run, but you certainly should avoid paying too much, at least over the short run. All right, so what is a growth company? A growth company is a firm that has the management ability and the opportunities to make investments that yield rates of return greater than the firm's required rate of return. The required rate of return is the average cost of capital. As a result, the firm's sales and earnings grow faster than those of other firms with equal risk and faster than the overall economy. So this is a growth company that has very good management and a company that has opportunities to make investments that generate above average growth, okay? Because of the availability of these investment opportunities, growth companies usually pay little or no dividends. When companies are growing rapidly, that means they are reinvesting in their companies, and that is a much better use of cash than paying out a dividend, okay? So they prefer to reinvest earnings rather than to pay them out. You are not buying the stock of a growth company to receive a dividend, at least not now. You are buying the stock of a growth company to participate in the success of the company and hopefully to get a capital gain on your stock. All right, what is a growth stock as opposed to a growth company? A growth stock is a stock that has a higher potential rate of return than other stocks with similar risk characteristics. Now, we're going to take a different look at growth stocks and value stocks in another chapter. Okay. The stock is expected to achieve superior returns because at some point in time, the market undervalues it. So this is a stock that has growth, superior growth potential. Imperfect information or an emotional response to negative news usually creates an undervalued situation. News comes out, people either don't understand it or they just don't react appropriately to it, and that creates a buying opportunity. All right, General Electric dropped today to $8 a share. In the past, when the multiples got this low for General Electric, this has been a great buying opportunity. We'll see if the management of General Electric can turn things around and turn this stock into a growth stock. All right, what is a defensive company? With a defensive company, earnings are likely to withstand an economic downturn. Examples are, and these are defensive industries: foods, drugs, utilities. People will pay for these items regardless of what our economic environment is like. What is a defensive stock? These stocks typically outperform in a bad market. What do we look for? Stocks with low betas, and we look for stocks from companies in defensive industries as long as the multiples are appropriate. Defensive companies tend to generate pretty stable results in good and in bad economic conditions. Defensive stocks generate returns that are in a tighter range than growth stocks, okay? So you can count on defensive stocks year in and year out, but I'll tell you what, if the economy is booming, you do not want to be invested in defensive stocks. You want to be invested in growth stocks. If the economy is decelerating, that's the time to be in these defensive stocks, okay? So defensive stocks will not rise as much as growth stocks in a bull market, and they won't fall as much as growth stocks in a bear market. But once again, if you're concerned about the market and you're thinking about getting into more defensive stocks, make sure you don't overpay for them, because you're not the only one witnessing a slowdown in the economy. You're not the only one thinking about buying defensive stocks. So when people start piling into any sector or industry or company, that stock price and those multiples will go up. All right. Defensive companies often have defensive stocks. Occasionally, a company in a defensive industry creates some novel form of comparative advantage. Okay? As a result, its income statement and its stock take on growth characteristics. Walmart, Dell, Facebook, Amazon, these are all good examples. Retailing and the PC industry were not considered to be growth industries. I guess Facebook's not a great example because Facebook Social media is considered to be a growth industry, but retailing was dead. Retailing was a defensive industry, and all of a sudden it changed. So really, Walmart, Dell, and Amazon are good examples. I would take Facebook off of there. Okay. All investment managers you know what? We're going to stop there. We've gone far enough. Let's not go too far. Shalom. Isn't this easy?